Hi, this is PR Sundar. Welcome to this special episode where I am going to talk about some strategy in options. The first thing, last week there was a big news. What is the big news? The India VIX fell to the lowest point since 2011. So which is about 12-year low. As an option seller, so one has to keep monitoring the VIX. India VIX is called the fear index. So when the VIX goes higher and higher, the option premium tend to be higher, the markets tend to make a violent move. To give you an example, in 2008 Lehman Brothers collapse time or 2020 coronavirus time, the India VIX went up to 85 to 90. And remember, usually it should be trading around below 30. Above 30 is considered to be very, very bad. Markets will be very, very volatile. And 15 to 30 is considered to be moderate, but anything below 15 is considered to be low VIX. And usually in a bull market, the VIX tend to be low. And that's what you are seeing. When the VIX is low, the markets kept moving higher. But however, that is not true always. Sometimes, opposite can happen. Number one. Number two, suddenly when the low VIX turns to higher VIX, when the VIX is low, the premiums will be low. First, let me explain how the VIX is calculated. The VIX is calculated, how it is calculated, it's a very big formula. Even as a mathematics teacher, I also don't understand. So big formula, forget about it. We will keep things very simple. India VIX is calculated based on 1 month option prices, whatever options that is expiring within 1 month, includes the weekly expiry, bi-weekly expiry, everything put together. If the VIX is very, very low, that means the option premiums are very, very low. When the VIX is very high, the option premiums will be very high. So what happens, option seller, when you sell the options, when the VIX is low, you get only lower premium. Suddenly for one or the other reason, and the VIX shoots up, then the premiums will shoot up, so that will go against the option seller. So option seller, time decay is always in his favor, but price can go against him and volatility index can also go against him. That is why for option sellers have to be very, very careful, and if it's a too high VIX is also not good and too low VIX is also not good. The VIX should be a moderate. But in a low VIX environment, what one can do? The question number one, low VIX, what one can do? Number two, sometimes people, experts, are the so-called experts like me. Sometimes we come and say 19,000 is a good support, 20,000 is the resistance. Markets are, this month is likely to trade between 19 and 20,000. Then, many people ask one question, sir, what is the use of all these things? If I buy when the market is at 19,800, if it is coming to 19,500, already I am going to lose 300 rupees. Then what is the point of saying market will take support around 19,000, market will take resistance around 20,000? So what is the use of all these things? Now I am going to show you how you can use, and of course, experts say, the so-called experts may be right or may be wrong. They have every right to be wrong. So, I'm just running a YouTube channel. So, therefore, I have to say something. Of course, I'm not trying to cheat anybody, but I'm just giving my views. My view can always go wrong. I'm not the God. Say, for example, last month, if you can remember, while the Nifty was moving higher, 18,900 was a stiff resistance and it crossed 18,900 few times, then fell. Markets moved violently between 18,650, 18,900. Then, one breakout happened. Nifty crossed 18,900. Then came to 19,300 and 400. Then 19,500 became a good resistance. Many times 19,500 was hit, then market fell. Then again one day it broke out, then jumped to 20,000. At that time, and sometimes a few weeks before, I've been telling, in the month of July, right, that 18,900 is a very, very good support because the last time resistance became a good support. Or even I said, because markets are very bullish, I said 19,000 put. I've been saying this month 19,000 to 20,000 is the range for this month. How we can capture? Very simple. I felt 19,000 to 20,000 is the range. But assuming that you also felt like that, what most people would have done, they would have sold 19,000 put option and 20,000 call option. But what happened? Nifty exactly traded between 19,000 and 20,000. But what happened? Last Thursday, Nifty went very close to 20,000. That time, the 20,000 call option you sold, if you have sold it for 100 rupees, that would have gone to 300, 400 rupees. Whereas 19,000 put option, if you have sold for 100 rupees, that would have come to 40, 50 rupees. Short strangle is a simple strategy most of the people follow. They sell call option at the resistance, they sell put option at the support. And then what happens when the market move violently either up or down? Assume that the markets move violently on the upside. The probability of market moving higher is very high because it's a bull market. The loss in the call option will be much higher than the profit in the put option. So this is where the people get trapped. In panic, they book the loss at 20,000 call, then market will reverse, will come back to 19.5. And then, you will get the fear on the downside and you will book the loss on the downside also. Therefore, combining these two, one, VIX is very low, how to create strategy. Number two, there's a problem in short strangle. So what you need to do, because the VIX is very, very low, anytime the VIX can shoot up, so the premiums can shoot up. So that also you have to keep in mind. So a simple thing, whenever you create a strategy, make sure there is some buy option also, there is some sell option also. Why? When the VIX shoots up, your sell option will also increase, but at the same time the buy option will also increase. So you will get some kind of a cushion. So number one, because the VIX is very low, so it's not a good idea to be a pure seller. You have some buy option and also some sell option. So that's one thing, right? And second thing, the problem in short strangle, as I told you, the resistance is 20,000, but it will go and touch the 20,000 and it will scare all the sellers of call option, then it will come down. Few days before, precisely, look here. So this one on 10th of July, night 9 o'clock. So one of my friends met me and he asked me, today, if you had to take, of course, I'm not trading in Indian markets, I'm trading only in US markets. But he asked me, sir, if you were to take a position today, what position you would have taken? Okay, so whatever I explained to you, the same thing I explained to him. So I said, VIX is very low, so I'm going to buy as well as sell some options. And number two, I strongly believe 19,000 is a support, or to be precise, 18,900 was a very, very strong support. 18,900 is a very, very strong support, and 20,000 is a very good resistance. What I suggested him, I put it in this software. And first thing is, a market is bullish, and I have told you already, for 3 months continuously market moved higher. 4th month also market moving higher. So that means, the probability of market moving higher is very, very high. I told him I would have bought 2 lots of 18,900 call option. Again, I repeat, I am not trading in Indian market. I am trading only in the US market. So this one is given to him for an educational purpose. So I would have, that's why I'm using the word, I would have bought 18,900 call option 2 lots, but that time it was trading around 734 rupees. But who will buy by paying so much money? In case market comes down, that 734 can go to zero. So that can lead to a loss of about 40,000 per lot. No, that's not an idea. And I am not an option buyer. After buying a 18,900 call option for 2 lots, 734, that means I would have paid about 1,500 rupees. But selling 7 lots of 20,000 call option at 118 rupees, and then selling 5 lots of put option, selling at 142 rupees. So what would have happened? I would have collected a small premium. If you look at here, this resulted in a small credit of 3,500 rupees. Okay, number one, let me come to the logic. 19,000 or precisely 18,900 is the support. Market is not likely to go below that. Therefore, I bought 18,900 call and sold 19,000 put. Because I sold 19,000 put for 142 rupees, so my lower break even will be below 18,850. That's well below 18,900, which is a very strong support. And 20,000 call option I sold. That's because 20,000 is the resistance. And because the volatility index is very low, I combine both buying and selling. And also I tell you one excellent thing. When you are selling 20,000 call sell, 18,900 call buy. What these people call this as a call ratio. Many people do call ratio, and when the markets are bullish, people do put ratio when the market is bearish. But here you see what I am doing. If I buy 2 lots and if I sell 7 lots, for 2 lots buy and 2 lots sell, the margin benefit will be given. So there is extra 5 lots sell, which is a naked sell. Because I have a 5 naked sell call option, when I sell 5 put options, okay, the margin benefit will be kicking in. So if you know very well, if I sell 1 call option, when I sell 1 put option, my span margin will be 0. I need to pay only exposure margin. Therefore, you can see here 2 lots buy, 7 lots sell. So the difference is 5. So that 5 lots I sold put option. I am not going by the textbook definition of call ratio and put ratio. So I am maximizing, I am optimizing my margin money. Okay. Again I repeat, I have not taken this. This one my friend asked me, you can see the time is not during the market hours, after the market hours. He met in the night time. So I just told him I would have done this that way. So optimum utilization of margin money is very important. In any business, optimum utilization of capital is very important. You can see the margin is roughly about 5.7 lakh rupees, and this one was done on 10th of July. This video is being shot on 26th of July, just about 15 days. 15 days must have about 10-11 trading session. You can see the profit is as of today is 20,000 rupees, so which is about 3.5% of the capital deployed. So 3.5% return in a matter of 2 weeks is really very good. And moreover, here the thing is, I'm selling call at resistance, selling put at the support, and then at the same time I also have some buy option. Now we are talking on 26th today, but imagine last Thursday what would have happened. The 20,000 call, it should have shot up like 300, 400, and still I can wait. That is because when the 20,000 call option is going, my 18,900 buy call option will also shoot up. If you can see as of today, still the 20,000 call option, there is a loss of about 32,000 rupees. Assume that I have done only the strangle. So the call I would have lost 32,000 rupees, put I would have gained only 25,000 rupees. So I would have still made 7,000 rupees loss. That is as of today. As of last Thursday when the market went to 20,000, this loss would have been 15,000, 20,000 also. But because I bought some option, so that has given a lot of cushion. Right now the loss is 32,000, but about 28,000 profit in the buy option. So that has given a cushion. So I am sitting with a net loss of only 4,000 rupees. Because the put side 25,000 is the profit, I am still sitting with a 20,000 rupees profit. Also you can look at the payoff chart. My lower break even is 18,962. That is about 18,900, which is a very good support. My resistance is 20,450. Also, although 20,000 is a resistance, my upper break even is 20,450 because I have some buy option. To conclude, 2 things. Number 1, if any expert come and tell you 19,000 is the support, 20,000 is the resistance, if you want to capture, you can create some strategies like this. Number 2, as long as the VIX is very low, don't do only naked option selling, always have some buy and some sell. So this is one of the strategies I used to discuss in my workshop. So in this video, I decided to give it free for all of you. So hope you enjoyed watching this video. Thank you for watching.